Hey guys, welcome back to the channel. In today's video, we're going to talk about 10 stocks that I'm choosing to buy right now. In the event you haven't checked the news recently, there's kind of a financial collapse happening, and if your job is secure and you have extra cash on hand, now is an excellent time to invest in the stock market. And of course, before we go any further, I must say I'm not a financial expert. I'm not a financial advisor. I'm just some guy on YouTube that likes to research things and then shares what he knows. Take this video as entertainment value only, not financial advice. Now, the first thing you should ask yourself before you buy individual stocks is, do you think you can outperform the market average? If you were to invest in a low-cost S&P 500 index fund, over the long run, you would expect to earn about 9.8%. We have 90 years worth of data, and if you just buy into the S&P 500, over a 20 or 30 year investment period, you will average about 9.8% a year. For that reason, in my own personal IRA and 401k, I'm still only buying S&P 500 index funds. They're all currently down about 30%, which is what the total stock market has lost. So if you buy that, it's still a great investment. However, I personally want to give this a try. You might want to give this a try. Can you outperform the market average by picking your own individual stocks? Last week on my channel, I made a much longer video talking about the criteria that investors look at when evaluating stocks. However, let's quickly recap what I'm looking for and what I think you should be looking for as well. And the first one is, how has the stock price done in the last 5 years? If it has doubled, the share price number has doubled in the last 5 years, then you know that it's outperformed the S&P 500. I'm also looking for stocks that pay any kind of dividend. I don't even care if it's a 0.5%, 1%, whatever. I like seeing companies that pay out just a small percentage of their profits to their shareholders as a dividend. I also went on my Charles Schwab brokerage account and I looked at all the profitability of these companies from the last 3 years. My thinking is if their company wasn't doing well and they weren't profitable and meeting their profit projections from the last 3 years, then they're really not going to be in good shape for this upcoming economic collapse. I'm also looking for well-established companies, preferably in the S&P 500, preferably with 20, 30 years worth of company history. There are a lot of fun penny stocks out there that wildly go up and down 20% sometimes in a day. I'm just not interested in investing in those kinds of companies at this time. I'm also looking to see how have these companies performed after the 2001 recession and the 2008 recession. Did they bounce back? Did their share price recover? These are things you'd be surprised when you just hit that max icon and look at their full history. And then finally, I'm looking for stocks that have very low chance of going bankrupt in the next 3 years. Everyone talks about the airline stocks, the hotel stocks, or the cruise line stocks. I don't care if the stock price is down 80%. If there's a decent chance that they could go bankrupt, then anything you buy now could be completely wiped out. And before I show you the 10 companies that I'm going to be investing in, I want to first show you a couple companies that I don't recommend. The first one being Amazon. Now, yes, their share price has quadrupled in the last 5 years. However, it really hasn't grown at all since August of 2018. That's not to say that this company couldn't quadruple again in the next 4 years. I just personally do not like seeing 100% growth stocks that kind of are overvalued. If you look at their P/E ratio, it's currently 82. In general, a lower P/E ratio is what you want to see. In addition, it doesn't pay a dividend, and its stock price peaked over 2 years ago. And if you were to be invested over the last 2 years, you haven't made anything from this Amazon stock yet. Now, of course, Amazon is a very successful, well-established company, one of the largest in the world. This stock could be good in the future. I'm just not interested in buying it at this price right now. The next kind of stocks that I kind of disqualify are pure dividend stocks. If you look at a company like ExxonMobil, their share price hasn't really changed at all over the last 5 years. Yes, there was the recent dip because of the crash, but their share price has been holding around 80, 85 for the last 5 years. The reason why is because they pay a really high dividend. And maybe I'm missing something. Leave me a comment down below if you know something I don't. But even with dividends reinvested, These pure dividend stocks like Coca-Cola, Johnson & Johnson, AT&T, they don't outperform the market average. Yes, maybe their stocks hold their value better during a recession, but if you're looking to hold an investment long term, 10, 20 years, I don't understand why you would be in a pure dividend stock when the S&P 500 index fund outperforms it consistently. Next up is stocks like Costco, and I definitely want to invest in Costco. I love this company. Their share price has been doing amazing. It pays a small dividend. However, there are lots of companies, maybe like Walmart and Costco, that even with this economic downturn, their share price has barely moved. Because they're still open and they're still allowed to operate, they might actually become more profitable as people have fewer options to go. And at this time, I'm just looking for stocks that have taken a 20 or 30% dip so that when you buy them now, you're getting them at a discount. Okay, now that you understand the criteria that I was looking for, let's start going through some stocks. And the first one is MasterCard. This is a company that everyone's heard of. And basically, MasterCard makes its money by being the middleman between vendors and banks. And I don't see this changing. When people use a debit card or a credit card, MasterCard is getting a small commission on every transaction. And this is a worldwide company. As banks and electronic payments become more popular, people don't write checks anymore. People don't carry around cash anymore. So I think MasterCard has had amazing profits and growths over the last 3 years. And when you look at what their share price has done since the early 2000s, it was once at $4 and now it's currently trading at over 240. In the last 5 years, their share price has gone up 292%, so it's almost tripled from 88 to a high of 347. That was the 52-week high down here. The PDE ratio is a little high, but I don't care. I still think MasterCard is going to be profitable in the future. The 52-week high, the current share price is down 31%, so if you were to buy into MasterCard now, you'd be getting a nice discount. The next company I'm going to be investing in is McDonald's, and this is one of the largest fast food chain companies in the world, obviously. McDonald's, I think, operates in every country in the world except North Korea. If you look at all of their profits and earnings from the last 3 years, this company was doing great. When you look at their share price, it doubled, it more than doubled within 5 years. It has a really high dividend payout at 3.12%. And the dip that it's seen has been 39% since its 52-week high. So if this is a company that you want to invest in long term, now is a great time to buy McDonald's. The next company is Ross Stores, Ross Dress for Less. And I'm going to be honest, I've never shopped at one of these stores. It's a discount department store based out of California. However, they've been doing really well. When you look at their profits from the last 3 years, the company has been doing great. When you look at their share price since the 80s, it's been consistent growth. It has a dividend payout of 1.53%. Its stock was up 140% within 5 years, and it's currently 40% down. Yes, all the stores are probably shut down now because of what's going on. However, I think this company will survive and do really well in the future. The next company you might want to buy into is Cintas Corporation, and this is a company that provides specialized services to businesses, primarily in North America. They provide stuff like uniforms, entrance mats, restroom cleaning and supplies, tile and carpet cleaning, promotional products, first aid, safety. They do a lot of stuff. They're based out of Ohio, and when you look at their profits from the last 3 years, they've been doing very well. They're going to take a hit, obviously, right now, but when you look at their stock growth since the 1980s, they've been up 270% in the last 5 years. They pay a 1.55 dividend, and they're currently 46% down from their 52-week high. So once again, a great stock that you can get at a discount right now. The next company I'm investing in is McCormick, and you probably have some of their spices in your kitchen cabinet right now. They make spices, seasoning, condiments, and other flavored products for industrial, restaurant, and home markets. This company is not a Fortune 500 company, but it is a Fortune 1000 company, so it's still fairly large, and it's based out of Maryland. When you look at their sales and profits from the last 3 years, this was a company doing very well for itself. I imagine with the restaurant industry being shut down, they're going to take a hit this quarter or this year. But when you look at their stock performance, they did fine after the 2001 collapse, the 2008 collapse. Their stock price was up 125% in the last 5 years. They pay a nice 1.69% dividend, and they're currently almost 16% down from their 52-week high. Next company is Cisco, and they're involved in marketing and distributing food products, smallwares, kitchen equipment, tabletop items in restaurants. Once again, this company is going to take a huge hit with all the restaurants being shut down. But when you look at their performance from the last 3 years, this was a very healthy company. And when you look at their stock price going back to the 2001 recession and the 2008 recession, they did fine. They actually have a really high dividend payout of 4.56, and they've got good growth. Their stock price 5 years ago was 38, and it more than doubled, up 125%. And currently, they're 50% down from their 52-week high. So yes, they're going to have a rough year, maybe a rough couple years, but I think this is a company that will come back. Next company I'm investing in is Visa, and yeah, MasterCard and Visa, it's kind of the same thing, but they're basically the middleman between banks and vendors all over the world. It's a global company. Visa is probably more widely accepted than MasterCard, but they're both doing very well for themselves. When you look at their earnings growth and profitability from the last 3 years, it's all green. In addition, you can look at their stock price, how it's done over the last 5 years, up 223%. They pay a small dividend, and it's currently almost 30% off what it was for its 52-week high. Next up is a company called Broadcom, and you might not know it, but it is a semiconductor and infrastructure software product company. They have a very large portfolio of services from data, networking, software, broadband, wireless, and storage capabilities. Like every other stock on this list, it was doing very well the last 3 years, and when you look at their share price, it was up 161% over the last 5 years, pays a really nice dividend payout of 5.55%, and it's currently 30% down from its 52-week high. Next up is S&P Global, and S&P stands for Standard & Poor's. Like the S&P 500 Index Fund, it's a business that offers financial information and analytics to institutional investors, people like you and me, literally everybody. And when you look at their earnings from the last 3 years, this was a very, very well-performing company. When you look at their share price, once again, fantastic growth the last 5 years, up 198%, pays a small dividend, 1.12%, and it's currently 23% down from its 52-week high. And then finally, we have Apple. I think a lot of people were getting nervous this might not make the list. If you're an iPhone user or an iMac user like I am, then buying stock in Apple just kind of gives you that Apple high. If you're an Android person, maybe you don't understand what I feel when I use Apple products. But Apple, once again, great company. The last 3 years, very profitable. And their share price was up 158% over the last 5 years, pays a small dividend, 1.28%, and it's currently 26% down from its 52-week high. Honestly, if I could just invest 100% in Apple, that would make me happy, but I know business-wise, that is a terrible financial decision. You should not invest just in one company, so this will only make up at most 5 to 10% of whatever my stock portfolio will eventually be. And there you have it, guys. Those are the 10 stocks that I'm choosing to buy right now. On the left, you have the ticker symbols if you want to Google them and then do more research for yourself. In my next video, I'm going to take you into my Charles Schwab brokerage account, and I'll actually show you my 30 stock portfolio that I'm currently building. Okay, guys, if you enjoyed this video, give it a thumbs up so the algorithm knows it's good. In addition, if you have any comments or questions, leave me one down below. I love hearing from you guys. And if you haven't subscribed to my channel, please consider subscribing. I'm going to post some more videos about stock buying and my Charles Schwab brokerage account. And until the next video, take care.